This video is a follow-up to the previous one I made on annuities and the fact that annuity sales have reached a 10-year high. In this video, I want to go into more detail about fixed-term annuities. There are several scenarios under which you might choose to use a part of your defined contribution pension pot to buy a fixed-term annuity rather than one that would last for the rest of your life. And here are the situations where that strategy could be beneficial. Number 1, bridging the gap until the state pension or other income begins. So in this scenario, this is for somebody who wants to retire at 60, but their state pension doesn't start until they are 67. And so they want to have some fixed income to bridge that gap. Scenario 2, waiting for better annuity rates. Interest rate or health related. So this scenario would be for somebody who is thinking about buying a lifetime annuity eventually, but at the time they want to purchase it, the rates weren't particularly attractive. And that could be because the annuity yields are low at that time, or simply because the age, health and other related factors for that person are not in favour of particularly high rates. So in that scenario, purchasing of a fixed term annuity could bridge that gap until higher rates become available in the future, because it's a simple principle of annuities that the older you get, generally speaking, the better the rates become. Number 3, providing a guaranteed income while leaving funds invested. This scenario could be for someone who is perhaps a little bit unsure about managing their own investments during retirement, but equally are not sure about committing all of their pension fund to an annuity either. Now, yes, you could use part of your pension pot to buy an annuity for the rest of your lifetime, but your uncertainty about annuities could be somewhat alleviated by simply buying a fixed-term annuity. This fixed-term annuity, using a portion of your pension funds, could be the amount that you need in order to cover your fixed living expenses, and you get that peace of mind knowing that you're covering your fixed living expenses, and you leave the rest invested in a drawdown. Number 4, covering a mortgage or other expenses. This scenario, somewhat related to the previous one, is for somebody that wants to retire but still has a mortgage or other significant loan repayments outstanding. In this case, purchasing annuity to cover the mortgage or loan repayments would mean that you would have the peace of mind that that was covered and you wouldn't have to dip into your investments. You would instead use your investments and what other income you had for your discretionary spend, knowing that the annuity was covering your mortgage. Number 5, protecting against market volatility, sequencing risk. So this is for someone who is concerned about market crash, a market downturn at the point that they are retiring, and you use a part of your pension in order to buy a fixed income so that you don't have to dip into your investments in a falling market, something called sequencing risk. Now, buying an annuity is not the only way to protect you against sequencing risk. You can build a cash ladder instead. This is just to point out that there are a number of ways that you can mitigate against the effects of sequencing risk, and buying a fixed term annuity could be one of them. Number 6, temporary higher income need before reducing lifestyle costs. So in this case, you're buying an annuity to cover your higher income needs in your early retirement before planning to scale back later on. Because by purchasing an annuity for the rest of your retirement at the start, you don't necessarily need that high level of income forever. And you might just need the higher income until, say, 75. In which case, a fixed term annuity could work well in that scenario, because after the annuity ends, you are then reliant on the lower income. Where to buy an annuity from? So when you are approaching the target retirement date that you have set with your pension platform provider, and you may have several pension pots across different pension platform providers, they will start to contact you about your options at retirement. And don't forget that the target retirement date that you have set with your various pension platform providers is entirely within your control. There's no set retirement date in the UK, and so you choose the target retirement date within your pension provider. So if you haven't chosen a specific date, the default within your provider could be 60, 65 or 67. So do go and check if you haven't already. And when you are approaching this date, they will contact you and explain your options. And they will typically explain that you can either use your pot to move into a drawdown or purchase an annuity, or a combination of both. Now, it's really important to understand that you do not have to buy an annuity with your current pension provider. You don't have to buy an annuity in the same place that your money is being held. In fact, financial regulations mandate that the platform providers have to inform their customers that they are under no obligation to buy an annuity with them and that they can shop around. So please do shop around if you are thinking about an annuity. According to data from the Financial Conduct Authority, 60% of annuities that are purchased within people's existing pension providers, suggesting that most people don't shop around. More details on fixed term annuities. I gave a sweeping overview of the different scenarios under which you might want to purchase a fixed term annuities earlier on in this video, but I've kept this part here for a bit more detail about exactly what fixed term annuities can involve. Obviously the clue is in the name, therefore a fixed duration. You choose the specific term that you want the annuity to last for, typically offered for between 3 and 25 years, although most commonly people choose fixed term annuities to last between 5 and 10 years. And the most common setup is when that term ends, you receive a predefined lump sum at the end of the term. And during that term, you get a fixed income. You can get some fixed term annuities that are escalating over the term. But obviously, if that's the case, they will typically start at a lower annual amount. And you can choose to be paid monthly, quarterly, or annually. Unlike lifetime annuities, fixed term annuities don't lock you in for life. At the end of the fixed term, if you've opted for a setup that gives you a lump sum at the end, you can then choose to use that money for purchasing another fixed term annuity, moving it into a drawdown, or taking that lump sum payment to do something else with. And many fixed term annuity providers still offer death in benefit options, so that if you were to die within the fixed term period, it would offer benefits to your spouse if that's important for you. I hope you found this overview of fixed term annuities useful. As ever, please do your own research. There are many comparison sites available that will use your personal data in order to give you a tailored quote that is appropriate for you and your needs. As a reminder, there's a link in the video description where you can book a free call with me. Thank you so much for watching to the end. Until the next time, Sullivan.